In October 2025, Bitcoin reached a peak of $126,200. Today, it sits in the mid-$60,000 range. This 50% wipeout left the retail market reeling. This chart compares the trajectory of the current crash against previous post-halving cycles. Historically, a crypto winter involves an 80% drop, a plunge that would drag Bitcoin all the way down to $25,000. Retail investors are watching the fear and greed index hit extreme lows, while bracing for that exact wipeout. However, analysts at firms like Bernstein look at this same data and see the weakest bear case in the history of the asset. To find the 2026 bottom, we have to look past the social media noise and analyze the three specific structural support floors currently holding the market up. The first layer of defense sits at $60,000. In this orderly correction scenario, the initial wave of selling hits a heavy, well-funded wall of buyers. Wall Street capital provides this weight. Spot ETFs are passively absorbing billions of dollars without the panic selling typical of individual traders, providing a massive shock absorber for the network. This floor is further reinforced by the potential for a U.S. strategic Bitcoin reserve and broader adoption by sovereign governments. These buyers treat Bitcoin as a long-term reserve asset, rather than a speculative trade. The shift toward institutional ownership creates a price floor based on cold risk management. Large asset managers defend their entry points, establishing a heavily protected cost basis. Breaking that institutional floor requires severe external pressure. If conflicts in the Middle East and sticky inflation force a liquidation of remaining speculative leverage, the price could slide lower. This chart shows the MVRV Z-score, a tool that measures the current market price against the actual historical cost paid for all coins in circulation. Right now, it sits at 0.5. A price drop to $55,000 would push this score down to the 0.0 baseline. Historically, when Bitcoin hits this green band, the asset is trading at its true cost basis, and smart money steps in to accumulate. $55,000 represents the on-chain mathematical baseline. This level defines the true fair value of the network, independent of market sentiment. The worst-case realistic bottom sits at $50,000. Reaching this level would require a collision between global economic policy and the physical limits of Bitcoin mining. That collision starts at the Federal Reserve. Under Chair Kevin Warsh, the bank has shifted away from immediate rate cuts, focusing instead on keeping interest rates higher for a longer period to manage structural inflation. Combine those high interest rates with global conflicts driving oil prices past $110 a barrel, and you create an environment that punishes all risk on assets. This macro pressure triggers miner capitulation. Currently, the average electricity and hardware cost to mine a single Bitcoin ranges from $77,000 to $87,000. At $50,000, many miners are operating at a loss. They are forced to power down their machines and liquidate their Bitcoin treasuries just to cover their operating expenses. This chart highlights the hash ribbon signal, which fires when weak miners finally shut down. When these two lines cross, it confirms that the forced selling pressure from those struggling operators has evaporated. Floor 3 is the ultimate physical failsafe. The market stabilizes once the sellers of last resort are forced out of the network. The 2026 bottom is an equilibrium zone between $50,000 and $60,000, supported by the cost of mining and institutional capital. The 80% crypto winter has disappeared. Look at how the severity of historical drawdowns has steadily shrunk, from 93% in 2011 down to a projected 55% today. This decreasing volatility shows Bitcoin aligning with the predictable behavior of traditional, maturing financial assets as institutional integration permanently alters the market landscape. To find the bottom, watch the specific signals, the MVRV Z-score reaching 0 and the miner hash ribbon crossing. When the weakest miners finally pull the plug, the 2026 bottom will lock in. This transition establishes Bitcoin as a predictable component of the global financial system.